Alright guys, so we've looked at two different systematic strategies. The first one we looked at was momentum, which rotates into the strongest stocks every month. Then we looked at mean reversion, which almost does the opposite. It buys short-term weakness inside longer-term uptrends. And today we're looking at another classic approach that behaves a little differently again. And this one is classic trend following. Now, trend following is actually one of the oldest systematic trading approaches in the world. Variations of this philosophy have been used for decades across different markets, especially in futures instruments by professional managers. And the core philosophy is extremely simple. So you cut losses quickly and let your winners run. So unlike momentum systems we looked at earlier, where we rebalance regularly, this strategy does something differently. Instead of exiting positions on a fixed schedule, the system simply stays invested for as long as the trend remains intact. So if a stock enters a powerful multi-month or even a multi-year move, the strategy can stay invested for the entire ride. And that's important because if you look at long-term stock market data, you'll find a surprisingly small number of stocks generate a large portion of total market returns. Most stocks actually underperform the index, but a small group of companies go on to produce extraordinary trends. And trend following systems are designed to identify those moves and stay in them as long as possible. Now before we continue, it's worth mentioning something about how this strategy fits into the broader portfolio. So in my own investing framework, I run multiple different strategies that capture different types of market behavior, as we've discussed on previous videos. Momentum captures medium-term leadership, mean reversion captures short-term overreactions, and then trend following captures large sustained moves. And alongside those equity strategies, I also have a long-short commodities futures system, which follows a similar set of trend following principles. And these types of strategies are often known or referred to as CTAs, or managed futures strategies, which many institutional investors use for added diversification and tail risk protection. These are often traded in futures markets like commodities, currencies, and interest rates. But we'll leave futures aside, and it's something we'll explore in future videos because it's a really interesting area of systematic investing. But for today, we're just focusing on trend following within the equity space. So let's walk through how this particular system works step by step. So the first thing the strategy does is apply a liquidity filter. We want to make sure that stocks we're trading have enough daily activity to enter and exit positions safely. In this system, we require roughly $1 million of weekly turnover. Now that's actually a relatively loose filter compared to some of the other strategies. And the reason we can be more flexible here is because trend following entries and exits are not urgent. We're not trying to capture tiny short-term moves. If necessary, positions can be built or reduced over a few days without significantly impacting performance. So liquidity does matter, but we don't need extremely tight filters for this particular strategy. The next step is looking at the broader market environment. Even though this is a stock picking strategy based on technical analysis, we still want to make sure the overall market backdrop is supportive. For this system, we look at the All Ordinaries Index in Australia and we simply check whether the index is trading above its 10-week moving average. If the index is above the average, we assume the market environment is supportive for long positions. If it isn't, the system becomes more defensive. And this type of simple regime filter helps keep the strategy aligned with the broader market trend. Trend following tends to perform best when the general market direction is upwards and healthy. Once we've filtered for liquidity in the broader market environment, the strategy then looks for breakout opportunities. Specifically, it looks for stocks that are breaking out to new highs over a long look-back period. In this case, around 100 weeks, which is almost 2 years. So imagine a stock that's been trading sideways or range-bound, consolidating over a long period of time. Then suddenly, it pushes to a new high that hasn't been seen for nearly 2 years. That can be a very powerful signal. It often indicates that something important is changing. Maybe strong earnings growth, maybe improving fundamentals, or maybe large institutional investors beginning to accumulate positions in the stock. The system simply waits for those breakouts and then enters when the price moves through that level. But the strategy doesn't stop there. From our testing, we know that not every breakout is worth trading. So the system also requires that the stock has already demonstrated strong momentum leading up to that breakout. So in other words, the stock must have already risen significantly over the past several months. This ensures that the strategy focuses on companies that have already shown clear signs of strength. We want to see that a trend is already beginning to form before committing capital. Now, when multiple stocks meet those conditions at the same time, the system needs a way to decide which ones to trade. The strategy allows for up to 10 positions at once. Capital is spread across those positions to maintain diversification. When there are more candidates than available positions, the system ranks them using a volatility-based score. Generally speaking, slightly less volatile stocks tend to receive a higher ranking. This helps keep the portfolio balanced and prevents excessive concentration in highly volatile names. Now here's where the strategy really becomes different from others we've looked at. Instead of exiting trades after a fixed holding period, the system uses what's known as a trailing stop. As the stock price rises, the trailing stop gradually moves up behind it. If the stock continues trending higher, the position simply remains open. But if the stock reverses and falls enough to trigger the stop, the position is closed. This creates a very powerful payoff structure, and this is something we'll explore in future videos. Most trades will produce relatively small gains or losses, but occasionally a stock will enter a major sustained trend, and the system will stay invested for the entire move. Those large winners can have a huge impact on long-term performance. This is the essence of trend following. Small losses, small gains, and the occasional very large winners. Something referred to in the industry as positive skew. Another interesting feature of this strategy is that the trailing stop adapts slightly depending on the broader market conditions. When the overall market is strong, the stop is allowed to sit further away from the price, giving the trend more room to breathe and develop. But if the market weakens, the stop becomes tighter, protecting capital more aggressively. This allows the system to adjust its risk profile automatically as the market conditions change. And one reason this strategy works particularly well is that it focuses on smaller and mid-cap companies. Generally, we find that larger cap companies often move more slowly because they're already widely owned. But smaller companies can sometimes experience very powerful growth phases. When a smaller company begins attracting institutional capital, the resulting demand can push the stock into a prolonged uptrend. And trend following strategies are specifically designed to capture those types of moves. And again, as we previously stated, this strategy is just one piece of a larger portfolio framework. Momentum strategies capture leadership, mean reversion strategies capture short-term pullbacks, and trend following captures large sustained breakdown. In my own personal portfolio, I include trend following strategies across global futures markets, which can provide great diversification and tail risk protection market stress. Each of these strategies behaves differently, and when combined together, they create a portfolio that is far more robust than relying on any single approach. So that's the basic idea behind this classic trend following system. We rely on rules to find stocks breaking out to long-term highs, we enter the trend, we manage risk with a trailing stop, and then we stay invested for as long as the trend continues. There's no prediction, there's no opinions, just a small set of rules applied consistently over time. And when combined with other strategies across different markets and timeframes, it becomes another building block in a diversified, systematic investing framework. Thanks for watching, guys, and I'll see you on the next one.